well, we're at that time of the year again where we try to look into the crystal ball backwards and forward. I think indeed the US consumer was the one that really held up the economy. And also the US economy by itself, the growth was really pulling the global growth because there was a lot of slowdown coming already from China and from Europe. I think at this stage, the employment level is the one to watch. Also, the job openings as a bit of a leading indicator. It seems as if jobs are very sticky at this stage because everyone had difficulties finding the right people. Now that they finally have them, they pay them well and they give them spending power, but at the same time, they don't want to lay them off until really they see the revenues falling down for whatever reason in their industry. And I believe that is really pulling the market, and that's also what the Fed is looking at this stage. Their dual mandate seems to shift a bit away from inflation into the employment and the economic growth and into an election year that's only going to become more important from the political side as well.
I mean, ultimately, the unemployment rates won't necessarily happen then going into next year either. So it means that they probably won't be firing. That means the economy perhaps holds up. The problem becomes, though, unfortunately, that it does make inflation a little bit sticky, surely, doesn't it? And that might mean you don't necessarily cut interest rates, especially the 6 times that the market might be looking for. That would mean a cut every meeting almost.
Well, I believe the market is indeed pricing in perfection at this stage. 6 rate cuts, although they might come very quickly once the economy really shows signs of weakness. I don't think the Fed will hesitate, but 6 might be a bit over the top. Time will tell. They could go into small cuts initially and then make them bigger going forward. But clearly, the employment is what they're watching as well. And inflation could come from an unexpected angle. Supply chain issues popping up again now with the issues of shipping at this stage where we don't really know where that's going to work out. That's clearly something which is a known unknown at this stage, and that could throw some dirt into the gearbox.
Bruno, let's touch then on to just this bond market as well. That has been a key focal area, around 120 basis points then lost since the highs of 5.02 back in October. I mean, that was quite significant for the market. Everybody was saying stay in the long-dated stuff. Do you still stay in the long-dated stuff going into next year?
Well, I believe that if there's one headline that I would call for next year, it would be "My name is Bond." I believe really that bonds are going to be the asset class that are going to continue to outperform. One shouldn't forget, if you look at a 20-year ETF from the top till the bottom, it lost 51%. I mean, that is something which hasn't taken the headlines as much as equities going down. I'm not saying that we're going back to negative interest rates, but this shifting of the yield curve, this going back to normalization, is clearly offering a lot of potential in an asset class which has suffered tremendously in the past years, which has shifted that money away into cash and money market funds. And if that rotation starts to come back, there's clearly quite some potential left in that. I would go and build up a ladder strategy, lengthening your duration along the way, and stay very, very high quality on the exposure.
Yeah. So what is